Our next guest's been sounding the bearish alarm for some time now, and he sees the S&P as of this morning with a new note falling perhaps to a level of 3,000. Joining us now is Mike Wilson, Chief Investment Officer, Chief U.S. Equity Strategist for Morgan Stanley. The way I read what you're saying, Mike, is not that you're forecasting 3,000, but that you're saying right now the sell-off has put multiples down to a more reasonable level, but does not factor in a recession. And if we did have a recession, then we'd get another 15 to 20% down. So we either get a recession or the risk of a recession is extinguished. So what are the chances that we get a recession and go down another 15 to 20%? It's not, is it 100%?
No, Joe, I mean, the reason we wrote today's note is because this is a question we're getting now from clients is, number one, is a recession already priced? People are asking that question. And then number two, what does a recession look like for the broader market? So we think the odds are sort of 50-50 now. I mean, they've increased materially since the beginning of the year for numerous reasons. We don't have to go through all those here. And look, the 3,000 basically incorporates the lower multiples, which was our main call for this year, with earnings going down by about 20%. So instead of 250 next year, we're closer to 200. And look, we're just not priced for that if that's the outcome. The issue, I think, though, is that the market can't really look forward until it knows the answer, right? I don't know the answer. You don't know the answer. Nobody knows the answer until we get there. As I like to say, bear markets end with a recession, just like in 2020, right? So as soon as the recession is obvious, that'll be probably the time you really want to step in. Of course, we could still avoid it, right? We could still have a soft landing. We're not saying that's impossible. In fact, our base case for this year is that we don't have a recession, but next year the odds go up significantly. But the market's going to have a really hard time looking forward until it knows that the risk of recession is extinguished. And we won't know the answer to that for at least 3 or 4 months is my guess.
It depends on inflation, I guess, too, because we don't know where the Fed necessarily will stop at this point. I think all bets are off, really, Mike. I don't, we just had a great energy analyst on talking about a easing of lockdowns in China could free up a lot of supply chain issues and really take some of the sting out of inflation, which would probably take some of the tightening off the table for the Fed. Plus, you've got this most recent break. The wealth effect has got to, at some point, and higher prices at some point are going to do the work for the Fed, won't it? Maybe the Fed doesn't need to go as far. If the Fed ever indicated that it was ratcheting down its terminal endpoint, I think that would be bullish, wouldn't it?
Well, we could get a little bit of that right now. I mean, look, our view, we've talked about this the last couple of months. I mean, I think the Fed's already gone far enough with its jawboning. I mean, the bond market always does the Fed's work for it by pricing in the number of rate hikes that they're planning on. And so they've been very aggressive with their guidance. And as a result, the terminal rate, as you point out, is close to 4%. I'd be very surprised if we get to 4% because, look, it's already having an enormous impact on the housing market, which is probably the single most important driver of the U.S. economy. And the housing market is really coming to a bit of a screeching halt. One of the large home builders is not even providing guidance now. So that's how uncertain it is. So I mean, we've done a lot of work. Prices have come down a ton. People's expectations are more realistic, except for earnings growth. And this is the other thing, Joe, we've talked about this, for all year, which is even in the event a recession is avoided, the earnings numbers are too high because the inflationary pressure on costs is now squeezing margins. I mean, our fire and ice narrative really is playing out to a T, and we've priced a lot of it. We just haven't priced it fully for the recessionary outcome. And even in the event we don't have a recession, it's hard to get much upside above sort of 3,900, 4,000. So you just got to be careful in your entry points here.
Right. But the difference between 4,000 and 3,000 is material.
That's right. So that's your risk reward, framework. Exactly. And so as we're rallying today, look, I wouldn't be surprised if we rally. I mean, we're so oversold. Our view is more consensus now. People are really bearish. Some people are more bearish than we are. And so, we priced a lot and we can rally. But you should understand that as you rally, the risk reward gets worse, not better.